Hey, what's up, everyone? This is Mr. T coming at you from Portable 3, right inside Portable 3, with my 750 Starbucks cards beside me and a monster living in the corner of my classroom. It is the air conditioner monster, and that monster is very loud right now because that monster needs to be fixed. So if you hear that monster in the corner, I apologize. I'm going to do my best to talk right into my microphone so that the volume is, or the background noise is not too crazy. And we'll get going with today's video. Today we're going to be talking about realistic expectations. Realistic expectations, okay? This is going to be linked to the math curriculum when we talk about investing, when we talk about money management and budgeting, and we want to have good expectations when we invest our money. Right now, we are knee deep. We have just finished 2 out of 5 weeks in an investing challenge, a stock market challenge. Over 1,200 students are participating in this. We are 2 out of 5 weeks through a stock market activity. And in the math curriculum, investing is one of the ways to make money. All right, it is in there. And so I want to have just a chat with you about realistic expectations. Now, if you would do me a favor and just give me a quick thumbs up, hit that little button right down below, give me a thumbs up. If you're not yet subscribed, hit the subscribe button, I'd really appreciate it. I have not posted a financial literacy video since May or June of last school year, almost 6 months ago. It's a long time, okay? Now, you know that last year when I posted my financial literacy videos, I always had a Starbucks card. And here is the one for today. I just want to give a big shout out to all you teachers. This one rolls back to 2015. Believe it or not, 2015, that's a long time ago. But we're going to talk about stock market expectations, okay? And I had a question for you. What is the average stock market return for the last 30 years? You can see right here, it is about 9.8%. 9.8%. Well, what does that mean? Well, in our stock market activity, I have loaded each student account with $10,000 of buying power. $10,000 of money that students are able to use to buy their stocks. You can see the activity started November 20th and it ends on December 22nd. So during that month, students are trying really, really hard to grow their stock market account. Okay, so there are 2 things that I want to point out to you in today's video. 2 pieces of information that I want to share with you. All right, number 1, there is something called a bull market and there's something called a bear market. A bull market is a year in which lots and lots of people make money. Okay, lots of money is flowing through the economy. Things are really, really well financially. People are making money. The opposite, though, is that there are things called bear markets. Bear markets, and those are years that are down. The stock market is down. People are, losing their jobs. Maybe groceries go way up, and those are years where people don't make a lot of money. Okay, now let me show you this. Check this out. This is a graph of the last 30 years. Oh, no, it's not. It's going back 20 years, not 30. Going back to the year 2000. Okay, and you can see that over the last 20 years, the stock market was green, or it was positive. It was a bull market in the year 2000. And then we had 3 years where the stock market went down. That's pretty difficult. And then we had a year that was up. Well, look at that. We had 5 years that were up. So my friends, if you were a student in the year 2003, 2004, 2006, you would have made money that year if your teacher hosted a stock market activity. But take a look at this. In the year 2008, there was this huge financial crisis and tons of people lost money. So if your teacher is hosting a stock market challenge during a bear market year, or even within a year, there are positive months and negative months. Maybe you're in a negative month. It's going to be really difficult to make money. But you can see that over the last 20 years, You're 12 years old right now. We're talking from age 12 to age 32. That's a long time. You can see that there have been more green years than red years, more positive years than negative years. You will have made money more times than you will have lost money. Most importantly is that over a long period of time, you will make money in the stock market if you're sticking it out and if you're choosing those good quality stocks. Okay? I want to show you Apple right now. Let's take a quick look at Apple. So we saw that in 2022, it was a bad year. So we're going to go to January of 2022. That's as close as I'm going to get. All right? And we're going to roll this across July, August, September, October, November, December, and January. Take a look right there. This, by the way, is the Apple stock. I should have shown you that before. This is Apple, okay? So in January of 2022, the Apple company lost about 27%, 26 to 27% of value. But in 2023, it's gained 47% of value. So in one particular year, it may have been bad, but 2 years before that were probably good, and the year after is probably good. And that is what I want you to get. What we're going to do is I've given you $10,000. $10,000 times 10%. That's about $1,000. All right, congratulations. $10,000 over the course of 10% or 1 year, you will make about $1,000. That's awesome. Well, let's turn that into months. Let's divide that by 12 months in the year, and let's find out per month what is the average rate of return. It is about $83. So, my friends, if you start with $10,000 and at the end of your 1 month stock market activity, you can be $10,100 or $10,083, you will have achieved the average rate of return for an average year in the stock market. All right. Now, it doesn't mean if you don't make $300, you are a bad trader. If you lose $50, you're a bad trader. That does not mean that. If you don't make $1,000 like your friend, it does not mean you are a bad investor. Please hear me. It is important. I'll say it really close. It is important. You are not a bad investor. What I want you to do is to have a realistic expectation. 2023, this year, this month, it is a positive time to invest. You will likely make money, but have a realistic expectation. Don't try and shoot for the stars. Just do your best, learn lots, buy different companies, and see if you can make about $100 at the end of the month. Okay? And that is what I want to challenge you with today. We've learned a little bit about bear markets, a little bit about bull markets, and a little bit about average rates of return. And teachers, if you want the handout down below in the video, you can go down and check that out. Okay, that will be there for you. And that's it for today. That's it. So episode, I honestly don't know what episode this is. It could be 009, it could be 010. I have no idea, but this is the next episode in my financial literacy journey, and I invite you to come along with me. Please like the video if you found it helpful. Subscribe, I'd really appreciate it. And until the next time, until the next Financial Lit video, I wish you a good day, and thank you so much for hanging out with me. Take care.